Good morning. It's Jeff Christian of CPM Group. It's just a little bit shy of 11 o'clock in the morning on Friday, the 4th of June. Today, I wanted to talk about central bank gold practices, and I'll get to that in a second. Also, I am throwing in a little chart on the relationship between U.S. federal debt and gold, more a matter of U.S. federal debt and GDP, but I'll go through that first, and then get into central bank gold practices. This chart is from the front piece of CPM Group's June Precious Metals Advisory, which we released late last night. It's dated June 4th. The front piece talks about, well, the title is Inflation Aside. And we talk about how inflation expectations, regardless of actual inflation, continues to be a major factor in gold investor and speculator purchases and sales practices, which has been reflected in the gold price over the last several weeks and will continue to be. But then we go into a very good, thorough discussion about the relationship between US federal deficits and debt and the dollar and gold. And these are very big issues that are very complex and often are overly simplified by people. One of the charts in that section is this chart here, which is a relationship of federal investment payments, interest payments, as a percentage of GDP. You have a lot of politicians waving their arms, wailing, gnashing their teeth, sitting on sackcloth and ashes, talking about how the GDP, the interest payments as GDP could skyrocket and be cataclysmic if interest rates start rising. And therefore the Fed has to do everything possible to keep interest rates low. And that's all pretty much true. But this chart puts it a little bit in perspective. And you can see how federal interest payments in the early 1980s skyrocketed. And they skyrocketed for a couple reasons. First was that the debt went from less than $1 trillion in 1980, the last Carter year, to several trillion dollars within 2 or 3 years due to enormous deficit spending by the Reagan administration, tax cuts, military expenditures. You know, they're not the party of tax and spend. They're the party of tax and borrow. And you had an enormous explosion in federal debt, which has continued to this day, but it started in the early 1980s. That was combined with Paul Volcker's Fed saying we have to kill inflation, and we do that with high interest rates. So he jacked up interest rates to 21% in late 1979, early 1980, squeezed inflation out of the system, but with the explosion of federal debt at the same time, raised the interest payments that the US government was paying. And you can see that for many years, up until around 1995, 1996, we were paying 2.5%, 2.8%, 3.2% of GDP in interest payments on the federal debt. Now, a couple things happened. First was that Clinton, for all of his warts, actually reduced federal deficit spending and turned a surplus, paying down the debt almost $1 trillion, or roughly $1 trillion, over the last 4 years of his administration. The other thing, which was really strange, is that once Clinton came in and started raising taxes here and there and started charging fees for government services, the bond market saw what was happening with US federal spending, and interest rates on US treasuries fell sharply starting in 1993, 1994. So that reduced the payment. All of which is important. It's all of which is history, and history could repeat itself if interest rates rise and we don't do something about our federal deficits and debt. We have problems, but let's put those problems in perspective. We've been there before. You'll also hear people talk about how the federal deficit or debt as a percentage of GDP is unsustainably high, and it's never been this high, and actually it has been higher. In 1947, the ratio of GDP, federal debt to GDP, was higher than it is today. And from 1947 until 1981, we paid down some of that. Actually, the deficit rose, the debt rose, but we grew the economy sharply. Coming out of the post-war period, we were 40+% of world GDP, and those were the miracle years. And we grew the economy, and we had a 90% marginal tax rate, and corporations paid taxes, and we actually reduced debt as a percentage of GDP from 1947 until 1981, when those Reagan budgets kicked in. So yeah, things are bad, but we have been here before. And if we look to history, there are solutions that are readily apparent. We don't need 90% tax rate, marginal tax rate. We don't even need the 60% that was basically the marginal tax rate from JFK through Jimmy Carter. You know, if we go up to 40, 41, 42% marginal tax rate, we start slashing those deficits very sharply. And we have the perspective and the potential to actually start turning surpluses again in a relatively painless way. But as we've said for years or decades, the political will to do those things doesn't exist in the United States right now. So that's that. June PMA, very interesting front piece. You can order it down below. Now, last week, we got this posting as a comment to our video last Friday, the 28th of May. I said, you know, great, you know, open silver discussion was phenomenal. Very interesting to understand the market better. We're getting a lot of comments like that, and that's what we do. We explain complex markets and realities to people who have been fed oversimplifications. He then said, you say central banks are less involved in gold markets than they used to be these days, yet we hear of reports of Russia getting out of dollars and increasing gold reserves. With all the money printing, do you think that central banks might start increasing their precious metals reserves? So what I wanted to do was talk about central banks and what they're doing and what their policies and opinions and practices are relative to gold and to currencies. Just to suffice it to say, Russia is something of a unique outlier. And when we're talking about central banks and their attitudes toward foreign exchange and gold reserves, we often say you have the rest of the world, and then you have Russia and a couple of its satellites like Kazakhstan and Belarus that sort of follow Russia's cue. But Russia has special circumstances and special ways of looking at its foreign exchange and gold reserves, which are very Russian. The chart on the background shows you, I studied Russian economics and politics in university, along with Chinese communist politics and economics. So Russia's kind of unique, but let's go through some of these numbers and talk about it. This is net purchases and sales of central bank gold going back to 1950. And you can see from 1960 to 1966, central banks were net buyers of gold. And that reflected the fact that we were on the Bretton Woods dollar gold standard. The United States was buying goods and services from around the world and paying for them with dollars. And under the Bretton Woods system, any central bank that had US dollars could go to the US Treasury and say, you say that the dollar is worth $35 an ounce. So here are my dollars, give me your gold. And you saw this big spike down in 1967 and 1968. And that was basically central banks and private corporations and others who could exchange their dollars for gold at $35 an ounce, exchanging their dollars. And you saw about 45 million ounces of US Treasury gold bought in 1967. And yeah, you saw about 24 million ounces in 1968. But the key about that number in 1968 is that LBJ closed the private sector gold window in April of 1968 after the Tet Offensive, and a variety of other issues that were going on, including a couple assassinations in the United States. It was a tough time in the United States. We saw 24 million ounces come out really in the first 3.5 months. So the US Treasury closed the gold window and said central banks can still exchange dollars for gold, but private corporations and private individuals can't. So that 24 represents a third of the year. And what the Treasury was doing was they were saying, okay, we thought it was bad last year when 45 million ounces came out of the Treasury's gold coffers. And we're already at 24 in the first 4 months. Let's multiply that by 3. We have to close the window. And they did. And then in 1971, Richard Nixon closed the what they called the public window, which was allowing central banks to turn in gold. So that's an interesting turning point. And it was the beginning of freeing the gold market and the gold price from government controls. We saw in the 1970s, late 1970s, about 50 million ounces or so of gold disgorged. Part of it was from the United States, and I'll show you some of the US figures later. And part of it was from the IMF. It was part of what they called the gold demonetization program. That really ended in 1979, 1980. Change of government, change of administrations. We saw a couple years of large purchases of gold, really from oil exporting countries. It was what they called petrodollar sterilization in 1981, 1982, kind of went away for a while. And then really starting in the late 80s and going through until about 2007, we saw a large period of time of central banks selling gold. And there were a couple things. First off, in 1989, we had the Maastricht Accord, which said that in January 1st, 1999, those European central banks that were opting into the European central banking system with the euro as their common currency would come under ECB regulations. So any central bank that wanted to reduce its gold holdings in that group had until January 1st, 1999 to do it on its own. After that, it would have to go to the ECB and would have to get permission and announce this is what our plan is. And central bank gold purchases and practices back in the 80s and 90s were extremely secretive. And there were several problems with that, one of which was tremendous rumor mongering. So you would find commercial banks and others floating rumors, oh, you know, England's going to be selling gold, Spain's selling gold, the Netherlands selling gold, Belgium selling gold. And the central banks basically kept quiet almost all of the time about that, but they didn't like being the butt of rumors. I would say no one actually likes being the butt of rumors. So there was a plan to do that. Now, Switzerland never wanted into the euro. And so it took a gentlemanly approach and said to the other European governments, we want to sell some of our gold. We have about 98% of our of our monetary reserves in gold, and we have a flatlining economy. So we want to reduce our gold stocks in half, go from 86 million ounces to 43 million ounces. But you guys have a deadline, January 1st, 1999. We don't. So we're going to be gentlemanly and we're going to wait until 1999 before we start selling. 1992, the European currency crisis came along and England opted out of what was then the EMS, the snake, and said it was not participate in the ECB and the euro. So they said, we also want to sell about half of our gold. We have about 19, 20 million ounces right now. And we want to go down to about 10 million ounces, but we will be gentlemanly and wait until 1999. It's very important because that comment was made in 1993. And one of the common misperceptions is that Gordon Brown, when he came in as Chancellor of the Exchequer, said, let's sell half of our gold. That decision was made years before Gordon Brown was the Chancellor. But like a good British politician, he's never said, you know, it actually was something I inherited. Like I said, it was all very secretive. It's less secretive now. At the same time, central banks were leasing a lot of gold out, and they would get 30 basis points, 50 basis points, 80 basis points interest on it. But it was a way of utilizing what was in many cases 80, 85, 90, 95, 98% of their monetary reserves in a time. Most of that stopped. And what we were saying was most of those central banks that wanted to sell gold have sold the gold they wanted to sell. And it was, I mean, there were a few countries like Australia and Canada and Japan, which severely reduced their gold holdings. But most of the European central banks were going to, well, let's have less than half of our monetary reserves under gold. So there was never a desire to get rid of all of their gold. It was a desire to increase their foreign exchange reserves, because foreign exchange reserves are much more useful if you have to defend your currency. If you have your monetary reserves in gold and you need to start buying your currency to support it because there's a movement among investors to dump your currency, you have to first sell your gold, and then you'll sell it, you'll get dollars, then you can use the dollars to buy your currency. And that first transaction of selling gold into dollars is very transparent to the key core banking community. And people see you selling gold, they know you're going to be buying your currency, so they can trade ahead of you. If you have your monetary reserves in dollars, you avoid that transparent first step, and you can come in and you can be more immediate and surprising in your currency defense program. So that was one of the reasons why central banks were reducing their gold holdings. A lot of that gold, all of that gold that they wanted to sell was sold really by 2007. 1999, the countries opting into the euro. 1999 through 2004 was supposed to be the 5-year window for Swiss and British sales, but they actually stretched it out into 2007. There were some economic crises going on at the time, and so they spread that out. Now, other central banks, Russia, China, India, that had not been big trading countries during the Bretton Woods era in the 1950s and 1960s, did not have a lot of gold reserves, but they had a lot of dollar reserves. They were starting to modernize, especially China and India. They had a massive inflow of dollars. Other countries like Thailand, South Korea, Taiwan, Hong Kong, which had its own monetary authorities, the Philippines, other countries that had not been building gold reserves under Bretton Woods said, we have this enormous amount of dollars, so let's start buying some gold as well as other currencies. And so what you saw around 2007, 2008 was the central banks that wanted to sell a lot of their gold had sold pretty much what they wanted to sell, and they were content with what they had left. And other central banks that had a lot of dollars started buying gold. And we've seen since 2008 net purchases ranging 5-6 million ounces to about 17, 18 million ounces in some years. And I'll get back to the price sensitivity of that. There also was this issue with the gold leasing, all of which was pretty much secretive. And central banks really pulled back from leasing gold. They pulled back for several reasons. One was that you had an increase in the amount of gold being held by sophisticated investors in the private sector, who also said, hey, I'll lease out my gold, and I will be far less stringent than the central banks in my leasing agreements. So you started having light leases, just as you were having in mortgages and collateralized swap obligations and a host of other financial transactions. So you started to see the central banks being less competitive than private sector lenders of gold. You also saw a decrease in the amount of gold that companies wanted to borrow. There was a pullback from using gold for project financing by mining companies in the early '80s. And there was also a reduction in the amount of gold being leased by the jewelry industry at the time. So the demand for leased gold was down. The supply of leased gold from non-official sources was rising. the risk of lending your gold to banks, to commercial banks, increased, and the interest rate that you could earn on your gold came down, partly because of the reduced demand and the increased supply. So central banks basically individually said, look, risks are higher, returns are lower, we don't need to lease this stuff, we're fine. And they basically pulled back. Leasing still continues, but most of the gold that's being leased is not owned by central banks, it's private sector groups. And that's another thing that really is largely overlooked in the gold market. Central banks were net sellers before 2008. Since 2008, they have started to rebuild their holdings. This only goes back to 1980. So you can see from 1980, really 1990, the start of that Maastricht sales, they went from 1,040,000,000 ounces down to about 840 million ounces. And now they're back up to about 990 million ounces in terms of central bank holdings. The composition of monetary reserves at central banks, meanwhile, exploded in terms of currency, primarily the dollar. I'll show you in a second. The yellow part at the bottom on the right left-hand scale, that's gold, and that's the value of the gold held. Now remember, central banks sold a tremendous amount of gold in the 70s, 80s, and 90s. But the value of that gold has gone from less than $1 trillion to more than $2 trillion because the gold price has increased. So they flooded the gold price and they sold gold. They sold maybe 10%, 15% of their gold, but the value of their gold remaining has increased. And you can see on the right-hand scale, really since about 1997, 1998, going forward, the percentage of monetary reserves held by central banks that's in gold has been pretty stable around 10%. It got up to about 14.8% at the end of last year. So it is rising partly because of the gold price rise and partly because central banks are buying more gold. This is the gross purchases, gross sales. It's that chart that I showed you before, broken down into gross purchases and sales, and you can see the net. And you can see prior to 2008, 2009, there were a lot of central banks selling 15, 20 million ounces of gold a year on a gross basis. And there were not a lot of central banks buying gold. That started to change 2008, 2009. The US Treasury did a wonderful job promoting gold investments to other central banks by virtue of its deplorable way of handling the global financial crisis and the Great Recession. And a lot of central banks, including China and Russia, and particularly China and Russia, said, you know, wow, thanks guys, we're getting rid of dollars and we're going to build gold. Now, I'll say this right here. China basically has not really sold dollars from its existing dollar reserves. What you've seen in China for most of the period since 2008 is that it has used its current inflow of dollars through its trade surpluses, and it's been converting some of that into gold. Russia's a little bit different story, as I said earlier. Central banks are more price sensitive than private investors, and you can see here a negative 66% correlation. When the price of gold is perceived as being low, central banks will buy more gold. When the price of gold is high, they buy less. Investors often do the opposite. So when investors, let's put this model into motion. Investors get worried about the world and they buy more gold. They drive the price higher and central banks buy less. You saw that in 2013, 2014. Then investors buy less gold and the price falls, and central banks say, well, if investors don't want to buy gold, if investors were willing to buy gold at $1,600 in 2012, but they don't want to buy it at $1,200 or $1,300 in 2014, 2015, we'll buy more. So central banks are price sensitive. They try to buy low, sell high, and investors tend to buy high, sell low, which is something to watch out for if you are an investor and you buy with the expectation of $50,000 gold or $2,000 silver, and then you get disappointed when the price goes back to $20 or $15 and you sell. which is what we saw in silver 2011 to 2019, and what we saw in gold 2011 to 2019 too. A lot of investors bought into the bull market, some because the price was rising, some because they had heard that gold was going to $10,000. And then when gold didn't go to $10,000, it went to $1,200, they sold, or their heirs sold. Central banks don't do that. Largest central bank holdings. The United States still has 261 million ounces. It's been assayed, it's been audited, it's there. And it represents 78.5% of this United States Treasury's monetary reserves. Now, again, another misperception. People say, well, the United States Treasury poo-poos gold and tells other central banks and investors that they shouldn't buy gold, but they have 78.5% of their monetary reserves in gold. You know, not very honest of it. Actually, it is very honest, and it has nothing to do with what you think. The bulk of monetary reserves are foreign exchange reserves, and I'll get to that in a second. The currency of choice for monetary reserves is US dollars. Other central banks can hold US dollars as foreign exchange reserves. The US government cannot hold US dollars as foreign exchange reserves. It does hold other currencies as monetary reserves and foreign exchange reserves, but it can't hold the dollar. And the dollar's got all the liquidity. I'll show you in a second. So it's not that the US Treasury is being disingenuous, it's that the US Treasury is the issuer of the reserve currency of choice at present, and it hasn't really the capacity. There's not a liquidity sufficient in euros, pounds, Swiss francs, yen for the US government to say, let's take some of our stuff out. Germany, they've sold a little bit. Italy hasn't really sold. France sold a little bit. Russia has been buying. And Russia now, it's very interesting. I'll show you a chart in a second. Russia has bought more gold, possibly than any other country except maybe China since 2008. And gold as a percentage of their reserves is 23.5% of their monetary reserves. China, just below them, has also bought a tremendous amount of gold. Those two countries alone represent about 75 or 80% of the gold that's been purchased by central banks since 2008. China's gold holdings have gone from about 1.5% to 3.5%. That's a function of a couple things. First is China has enormous dollar and other currency reserves, trillions of dollars, and it's running big surpluses on its current account trade balance. So it's got currencies coming in every month, and it's converting a little bit of that into gold, but not so much as to make gold an enormous portion of its reserves. And it sort of sees itself as an emerging world leader, or the emerging world leader. Russia doesn't have a lot of reserves in currencies. Russia doesn't have massive trade surpluses. Russia actually was running trade deficits when the oil price fell a year ago. And Russia has a great deal of concerns about the way the rest of the world looks at it. So Russia, and it has sanctions against it, and it has a very hostile US government toward it, and it has pretty hostile European government toward it. And there are any number of other countries that I won't mention that don't have the best relations or attitudes toward Russia, and the Russian government feels that. So they have a castle-like mentality, if you will. They preserve the motherland, and they have been moving more assets into gold than any other country. Other countries have been following the China mold and saying, hey, let's diversify our reserves, and gold can play an important but not enormous portion of our monetary reserve policies. And then a couple countries like Kazakhstan and Belarus are following the Russian model. But Russia stands out. And when you see Russia buying gold, that doesn't mean the other central banks are buying gold. And here, these are developing economies, gold. And you can see Russia has head and shoulders more gold than other developing countries, and it's 23%. I'm not sure who this is. This is China. It's not listed there, but it's 63 million ounces, and it's 3.5%. India is down here, a little over 20 million ounces, and everybody else is down there. So it's not a broad-based purchasing of gold by central banks. It's really been a dozen or 20 different central banks out of 180 that have been doing the buying. Turkey has been buying gold, and Turkey is also using its gold. It allows commercial banks to meet some of their reserve requirements with the Turkish central bank in gold, 10% valued at market, the next 20% valued at 80% of the market. And you see this red stuff. I mean, the Turkish central bank had not been buying gold for its own holdings since the 70s, but they did start in 2017. But in 2011, during the Euro crisis and the Greek crisis and the Greek problems, and the ECB didn't have the legal wherewithal to bail out the Greek government, there was an enormous amount of gold, dollars, and euros that flowed into Turkey, and Turkey was watching its major trading partners, the European Union, suffer. And so Turkey changed the rules and said you can meet 10% of your reserves with gold and 10% in dollars and euros. And then in January of 2012, they upped the gold portion to 30%. And this red portion is really that reserve option mechanism gold. Then other things changed in 2017, and the Turkish central bank started buying gold for itself. It is unique in some ways with this. India does this too, and somebody told me last week, and because of my age, I've forgotten which country. There is a third country that actually is using its gold monetary reserves for monetary policies other than reserves, and that's one of the things that we work on, encouraging central banks to mobilize their gold and use it. Now, these are foreign exchange reserves by central banks. And it's great because you'll find people who will take this little period here, 2016 to 2020, 21, and they'll say, oh my God, central banks are dumping gold. Look at this chart. And they'll skew with the table, the chart, the scale, and say, central banks have gone from 63% of their gold dollar foreign exchange reserves being in dollars to 62%. They're getting out of dollars. But if you look at it, they're not. And partly, as I've said many times in these videos, the US government follows a policy: if you owe the world enough, you own it. The liquidity of the dollars is so enormous compared to other currencies that other central banks that need to hold foreign exchange reserves basically find themselves holding dollars. And you can see that at 61, 62% at current levels, the percentage of monetary reserves in dollars is actually higher than it was back in 1995. You did see this increase from 1995 to 2000, and that represented the fact that you had all these European central banks that had other European currencies in their foreign exchange reserves. And as they moved to January 1st, 1999 and joined the euro, they had to get rid of those other European reserves. So they sold those other currencies and bought dollars. And you saw the dollar go from 59, 58% up to about 68% in the transition to the euro. Once that was over, and a couple other things happened, you started seeing central banks reduce their dollar holdings and start to re-diversify their portfolio. So they're not dumping dollars. And anybody who tells you that is trying to sell you gold. That's the metrics on central banks. We are moving toward our first challenger assumption open forum. Fora is the plural of forum. In case you're wondering what a fora is, it's forums, because we hope to do those on a quarterly basis. They are open to all CPM Group clients, including retail investor, people who are subscribing to our retail investor program. You can read about the retail investor program and other services that we have at our website. You can sign up as a retail investor. If you are a client, you will be invited to join the Challenge Your Assumption open fora on a quarterly basis starting on June 22nd, 10 a.m. And they will be available to clients on a recorded basis. You can order our silver yearbook, you can order our gold yearbook. You can send us information at info@cpmgroup.com about ways that we can help you. As I've said before, CPM Group, I personally have been involved in precious metals since the 1970s. I personally have a very keen interest in investing in precious metals and precious metals assets. I have a very good track record of calling the markets ups and downs, basically because I don't believe. I try to analyze the market. We gather a tremendous amount of information, not only me, but the entire research group at CPM Group. And we try to have an unbiased approach. Do we think gold, silver prices are rising or falling? Platinum, palladium, vanadium, manganese, molybdenum, other metals too. Yeah, I mentioned on my video Wednesday that there was one guy who said, wow, why is CPM Group issuing, almost every week they issue price outlook for the following week. Well, that's what happens if you issue weekly projections. Hey, I'd be a buyer here, I'd be a seller here. You have to update it on a weekly basis. A little other housework. 2,000 milliliter Florence flask goes back to my days as a chemistry geek in high school. And the hybrid flowers in it are from what was my mother's garden. She had hybrid peonies and hybrid irises. And when I bought my first house in 1981, I got some of them. So those are her hybrid peonies. The Soviet era chart I've described. We're here to help people understand the markets, to cut through the garbage. If you see a video of Keith Neumeyer that looks like it's been jumbled together and he's criticizing GFMS, but he's made to look like he's criticizing CPM Group, he was criticizing GFMS. If somebody is giving you bullshit like that, you probably want to call CPM Group and say, I need to step up to quality. I need to get better information and research and analysis. I need to be able to send a note to CPM Group at info@cpmgroup.com and say, hey, I've just heard that this was a real one. I've just heard that Treasury security agents are going through bank deposit, safety deposit boxes, taking people's gold and silver. No, they aren't. They didn't even do that in 1933, truth be told, and they're not doing it now. And unfortunately, sometimes we get to talk to our clients about really substantive things like what are central banks' policies and practices toward gold. And other times we have to talk to them about, don't worry, the Treasury's not going through banks taking people's gold and silver. But that's what we do. We help investors invest smartly, intelligently, based on knowledge, statistics, facts, and unbiased views. Thank you. Have a good weekend. Enjoy yourselves, and we'll talk next week.